Shares in the US company GameStop have fallen back sharply in after-hours trading on Wall Street. The gaming company is seen as a target for so-called short sellers who make money when share prices fall. Experts say small investors working together have been buying shares in GameStop and other firms to push their prices up and inflict losses on the big funds. Bailey Lipschultz is a reporter with Bloomberg and he joins us now from New York. Bailey Lipschultz, welcome. So put this in layman's terms for us. Is it fair enough to describe this as the little guys rising up and fighting back against big financial players who make huge amounts of money using questionable tactics?
I think that's certainly fair and very spot on. We're seeing really a battle, as you said, of David and Goliath. We're seeing Wall Street hedge funds against day traders, retail traders, people who are realizing there is strength in numbers, that when they get into a forum like a Reddit or something like Twitter, that they can really rally against Wall Street and continue to bid up stocks. And we've seen that play out in the last week. And so far this year, GameStop shares are up about 900%. So really inflicting some pain to Wall Street and hedge funds.
Does it look like some of these big players could lose billions over this or not?
So far, we're seeing that. We're seeing Melvin Capitals came out and said they took a substantial loss, according to reports. We've seen Citron Research, which is a very highly regarded short seller. They've come out and said they lost about 100% on most of their short bets. So it has worked. And we've seen some of these players and bigger players continue to, at least reports show, them losing money. And it's definitely, at least as of now, hitting them in the pocket. But it remains to be seen what happens when this mania continues to play out. It seems like every day is a new turn on the roller coaster.
Yeah, and this is happening not only with GameStop.
Yeah, we're seeing it with AMC. We've seen it with a couple very small speculative stocks. The big deal is, and the big thing is, these Reddit traders, these retail investors using things like Robinhood are going after companies that, as you said, have a high short interest, have a lot of investors betting against the company's success, and realizing that kind of how the stock market works, with there being strength in numbers, if they all throw a couple $1,000s and you have 1 million people, you can really inflict pain and drive these stocks very, very high and see that exponential growth we've been seeing on across Wall Street.
But has that tactic been inhibited over the past 24 hours or so with some actions?
It has. Robinhood, Interactive Brokers, and I believe E-Trade came out and were limiting the ability to buy stocks through their app. So limiting going after GameStop, limiting trades on something like Bed Bath & Beyond that are seeing these enormous amounts of volume. And that, in part, according to my sources, has led to the declines we saw today. A lot of people that I know on Wall Street have said that these stocks were rising because there was such a high demand for the shares because of these smaller traders. And if you limit their ability to buy, then there's no one there to buy and continue to fuel the climbs that we've seen in the last few days.
But does it look like these smaller operators will end up losing, if they've kind of invested $1,000 or $2,000 in GameStop, does it look like they will inevitably lose their money on that?
Well, as one investor told me a couple days ago, some people are going to make 600% or 1,000%, and they're going to brag about it. But for every person making a killing, there's someone losing money. So the big question is how this mania ends up. No one really exactly knows where it'll be. But at the end of the day, if the stocks are going to go down, whoever's caught kind of, as they say, holding the bag will be the one who bears the brunt of those losses.
But presumably some of those people will put up with those losses and celebrate the fact that they've been able to stick it up to some of the big players.
That's been the feel on a lot of these threads on platforms like Reddit or on platforms like Discord, is that they don't really care if they lose money. They're in it for the ride and for the ability to kind of rage against the Wall Street machine, if you will, and kind of stick it to the man. And we've been seeing that with a lot of the dialogue coming across the US, be it in DC or from individual investors just kind of saying, hey, we're causing something, we're starting a movement potentially. And it'll be interesting to see how this plays out.
And as far, you're a finance journo, so I'm not sure how independent you'll be able to talk about this, but so what do you feel about the moral argument here? These smaller operators are getting together and fighting the bigger operators, presumably because they see their tactics as questionable when they are making money on the failure of companies.
You're right. I can't speculate too much on that, but I have talked to sources on both sides. Some sources are saying, hey, at the end of the day, if some of these short investors were over their skis, that problem's on them for not taking the proper precautions, and others who have a little bit more sympathy for some of these more traditional investors and have concern about what this could mean from the stock market. But definitely having conversations on both sides of that across Wall Street, just given kind of how hotly debated and how much dialogue there is going around this story, because it really has been the investment story of the year so far in 2021.
Yeah, and how much influence has this GameStop incident and other action around a couple of other companies that you mentioned, like AMC, how much influence did that have on the volatility of the market over the past 24, 48 hours?
A lot of folks on Wall Street were pinning the market sell-off yesterday. It was the worst day, I believe, since October. We're pinning that on hedge funds and money managers having to protect their other bets. So selling big stocks, selling the S&P 500, just so they could have cash on hand to protect against further downside in these stocks. Again, it was a one-day phenomenon. The stock market broadly bounced back today, and a lot of people on Wall Street had flicked that, though, saying that if we see a lot of volatility across smaller positions, hedge funds and money managers who weren't protected or prepared for that sell-off could have to liquidate or sell down some positions to make sure they're protecting their gains and protecting what's happened across the stock market in the last, 6, 12, 18 months.
Yeah. And so could this well lead to a fundamental rethink of strategies by some of the big players?
I think that remains to be seen, but I've talked to a number of short sellers who said this is something that they have to think about. I've spoken to, again, a couple of hedge fund managers and long-only investment managers who have said, we have to be aware of this. It's changed our view of Wall Street because this is not necessarily like the dot-com bubble or the financial crisis in 2008. This is partly an entirely new beast and something that they have to adapt and survive to. And keep in mind that there is this retail demand. There are smaller investors who want to have a say in where they're putting their money as opposed to, buying a car or a house. And that's going to likely be a part of the market going forward. And it'll be an interesting story to see how it shakes out again in the next day, week, and even next 5 to 10 years, just to see really what happens and how kind of the rage against Wall Street ultimately changes the financial market.
Yeah. Bailey Lipschultz, thanks so much for explaining that all so clearly, because it can be a bit of a confusing subject. But yeah, that's all been really clear. So thanks so much for having me chat to us.
Thanks for having me on.